But what's a girl to do, guys? What's a girl to do? Before we delve in here, grab a cuppa and get comfy. Bubble trouble. What is going on? And I really wanted to find out if the bubble fears are real. And if so, what should we be doing with our investing? I'm not gonna lie, it does seem like we have bubble trouble every year. It's what sells newspapers and has been plastered all over sites like Bloomberg even in recent weeks. But should we really listen? Let's sprinkle the facts and find out. And as a novice investor, I can tell you one of the hardest things to overcome is the extreme emotions of fear and greed. And boy, do the media know that. Every year we'll find news stories which suggest extreme ups and downs within the market, and every year investors react with surprise, greed and fear. Remember all of those things. Now, according to the press, greed is everywhere, and it's hard not to, on the face of it, strongly agree. Penny stocks are surging. Literally, what has always been a riskier investment is a favorite go-to for investors. Cash is being poured into thematic bets. This is basically a fancy way of saying macro trends, or even more simply, what the world is going to look like, which is now very rosy with the end of the pandemic apparently in sight. There is really nothing left but to invest into the stock market, and pour in we do, guys. Just keep buying, and the market is showing that too. At the time of recording, what is it, midweek after Valentine's Day, the S&P 500 is up 6.3% year to date, the FTSE up around 3%, and the Nasdaq getting close to up 11%, up double digits. Guys, honestly, what is going on? But what happens when markets show high signs of exuberance like this? Well, like clockwork, the macro news teams of all the large investment banks such as Citi and JP warn of market excess and take a more measured approach to the markets. However, with more stimulus, money printing, and even fiscal stimulus to continue, many firms are telling their clients to stay invested with the rally. But what's a girl to do, guys? What's a girl to do? One of the fundamental ratios we look at as investors is the PE ratio. This is basically how much an investor is prepared to pay for earnings, and it's looked at as a multiple. So in its simplest form, how much an investor needs to pay to buy a share of their earnings. The higher the PE ratio, the more the investor is actually willing to pay for a share of companies' revenues. So when looking at PEs, it's important to look at relatives. So for instance, our darling Tesla has a PE ratio of over 1,000, whereas JP Morgan, like the bank, has a PE ratio of 15. But Tesla is a high growth company, so investors will pay up to own those shares of Tesla. Now, let's go back to PE ratios as a gauge of value, and one of the cool things we can do is look at the historic PE trends of what the market looks like. So let's do that. So yeah, PEs are high and actually at similar levels now to the dot-com bubble. Isn't that interesting? And as a millennial, I remember those days, and so can draw comfort that today is very different from the dot-com bubble. Back then, investors were piling into internet companies that had no proven business model, no revenue streams, and no proof of concept. However, as some companies were starting to develop, the crazes emerged, pushing valuations up. The dot-com bubble didn't end well, and we all know it. And in another video, I also talk about the CAPE indicator, which is basically similar to the PE ratio, but taking out changes due to, say, seasonality. I'll link that video at the end if you're interested. My favorite indicator, though, at the moment when looking at market exuberance is the Buffett indicator. Which is where Buffett compares the real economy versus the growth of the stock market. The Buffett indicator has never been higher. Our stock markets are trading at 221%, guys, of GDP, and never has it been so high. And this for me was the scariest indicator actually. But should we panic and sell everything? Well, first, there is a bit of a disconnect between what investors say and what investors do, as is with life really. And the critical result to look for is the levels of speculation. A speculation shows a move away from the real value of the market and precedes a bubble. Yes, right now the indicators are showing that the market is showing increased levels of speculation, and so we should be eyeing up the door, right? Let's run. No. Well, much of the speculation elements are coming from retail investors who have bloomed in numbers with trading apps and increased confidence trading in a trending up market. Now, something I realized very early when starting to invest in real estate and understanding the credit crunch recession of 2008 is that confidence is easy to come by, guys, in a rising market, which is the benefit of being a lockdown trader. The boom of retail activity started when our economies were entering lockdown. And guess what? From the bottom of the market in March 2010 to now, mid-February, the S&P 500 is up 76% from lows of, what was it, 2237 back in March to 3930 now. The Nasdaq, this is going to actually blow your mind, was down at 6,879 in mid-March and now valued at 14,000, guys. That's more than doubled. Literally, corrections make the best investment opportunities. It's crazy, and you would not really have to do much to make money in those cases. And I'm sorry if you haven't, guys, and you missed the boat, but just wait for the next one. But it also makes us think, surely this is going to end soon. It can't go on. Of course, here comes the caution. As long-term investors, it's always a bad idea to chase. It's all about having a plan, sticking to it. And that's the important thing here. Remember Buffett's heeding, and just realize that bubbles can burst, even if the banks think they will float higher and higher. Some banks are even suggesting between a 50 to 100% higher float before a slowdown or correction even takes place. And that's how the banks and markets are feeling. But where are the bubble fears coming from? All my top finance YouTubers have posted videos in the last week or so around bubble trouble, and it's from a few key stories which revolve around some crazy stories, right? Day trading booms, cryptocurrency booms, which all make it feel like we are living in a very speculative market, and it's likely to go on, guys. However, the key thing we need to understand are with interest rates, and that we are so low and likely to stay low for a while with all the money printing going on. Interest rates in real terms are negative. Bank yields are at record lows, and inflation is expecting to kick in, all working to erode away cash further. There really is no point sitting on the sidelines, is there? As an investor, you're actually paying a lot more not to invest. But with interest rates unanimously by all central banks expected to stay low, there really is nowhere else to park your money or your car. So while the stock market may seem like a rip-off, there is nowhere else to go, really. It's probably unlikely to come plummeting down, and that's for sure. However, and this is going to be my last however, I promise, with it trading at multiples and being, you know, a scientist here and all that jazz, I can see the graph will look choppy on day-to-day and a month-to-month basis, as nerves will also be quite ripe. All the professional money managers can actually see this and will be quite quick to react and overreact. But that being said, as we always say, it's time in the market, not time in the market. And sitting on the sidelines can be a really dangerous thing to do. Just imagine if you had put your money into cash as economies were going into lockdown and didn't really get back in it for a while. That would be devastating. So for now, I keep investing consistently and remember some of the principles of dollar or pound cost averaging if I have a lump sum to pile in. Here are a bunch of videos which you look at the CAPE and the concept of dollar and pound cost averaging really well with this video. And it's quite helpful if you want to remind yourself of some simple strategies to maximize returns while still being a passive investor. So I'll see you over there. Now, I hope that tea hasn't got cold.